One of the most common questions I get is what's the difference between a fixed and a variable rate mortgage? So let's talk about it. Now, a fixed rate mortgage is exactly that. You have a fixed payment and a fixed amortization schedule. So if you're expecting to pay it off in 25 years, you stay on that schedule, you'll be paid off in 25 years. The cons with this type of product has the highest penalty rate. So big banks are going to charge really high penalties on this. This is what you're going to see in the news when you look at penalty issues. It's usually with these type of products. Mono lenders, so they only do mortgages, they're going to be a little bit cheaper. So that's definitely something to consider as well. It is the least flexible product, but again, it has stability as well because you know exactly what you're going to get. Now, looking at variable, there are two types of variable. There's the variable interest rate mortgage, so a VIRM. This has a static type payment, so each month your payment's going to be the same. If rates go up, less of that payment goes to your principal, more of it goes to interest. If interest rates come down, more of that goes to your principal and less to interest. So what that does is going to impact your amortization. It is going to change throughout the course of your mortgage based off how rates change. Now, some of the pros, you can lock it in at any point to fixed. It has low penalties, so usually 3 months of interest. And over the course of time, it is usually beneficial from a cost savings standpoint compared to fixed. Cons, the amortization schedule, as mentioned, does change based off where the rate is. Few lenders offer this product. Basically, we're down to a couple of the big banks. Most of them gone to the second product, which is called an ARM, and I'll talk about it in a second. And if there are any major swings in interest rate, they can hit something called, which is a trigger rate, and they rebalance it. So that's a much more complicated piece to this, so we can talk about that another time, but that is something to be aware of. Now, as I just alluded to, adjustable rate mortgage, that's the second type of variable mortgage. Very flexible product, low penalties, so again, 3 months of interest. Amortization doesn't change. So your payment within the term goes up and down based off interest rate changes. So if interest rate goes up, your payment goes up. If interest rates come down, your payment comes down. This keeps your amortization whole through the course of the term. Now, this can appear to be unstable in a rapidly changing environment. So as rates were going up really high, really quickly in 2023, constant payment adjustments, it made people nervous, like what's going on? But what that was is keeping your amortization whole. So at the end of your term, you're still on track for the original amortization. So if you're in a 30-year amortization, you're still in a 30-year amortization. So as far as what is the best product for you, it really comes down to what your needs are, what your financial objectives are, and what you're planning to do with the house. So again, if you're looking to move in a couple of years, fixed might not be the right option for you. If you're on a fixed budget though, fixed might be the right option for you. So make sure you talk to your mortgage professional, your mortgage broker or agent, and ask those questions. Find out what the right product is for you, and yeah, if you have questions, let me know.